This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. I hope you're well and smiling, navigating this period as we run up to the federal election. I've been sort of chatting a little bit about it, and I've had a number of different commentators coming onto the podcast. And by and large, most of them are saying don't overthink, don't oversweat the election, irrespective of who is leading the country, Prime Minister or which party. Won't necessarily shape what you do immediately in property investing because it's a long-term play. You shouldn't be investing for what's happening now. You should be thinking about what's the next 10, 20, 30, 40 years look like as a property investor. And that's what the best property investors do. They look at past performance of properties, of suburbs in different locations, and they look to emulate that through smart buying, the right asset, the right time in the right place to at least get some continuity of that. And you find that some markets are feast and famine and some are very consistent performers. Early on in your investing, you probably want to be trying to find those places which are pretty consistent. And once you've got a bit of skin in the game and you've got a bit more to play with, you can start thinking about what you can do to maybe be a little bit more speculative. But I don't champion the notion of speculative investing. I'd be pretty thorough with how you go through things. The investor in the studio today, and I love talking to property investors from the very quick sort of brief I've had on this investor, it sounds like he's played the smart game, he's playing the long game. Ryan O'Neill joins me in the studio. Ryan, how are you going?
Yeah, g'day, Phil. How you going? Good, thanks. Thanks for having me.
That's right. So you're a property investor, Ryan. You've been at it for a little while.
My wife and I, yes, there's two of us in the game. Well, she won't come on. She doesn't like the limelight as such. So I've come on, yeah. So we've been doing this since, investing anyway, since 2013. Okay. And like you said, it's for a long-term retirement plan. There's no sort of quick sort of strategy on this one.
Yeah, and this is for a lot of people. I'd say most people. They invest in property for the purpose of creating wealth, to give them choice when it comes to retirement. What retirement means for different people is largely irrelevant. But what normally happens is that if you do this the right way, you actually get a choice at a point in time. You can choose what retirement looks like for you. Ryan, how far through your sort of working life are you now? And I won't ask how old your wife is, but I'll ask you how old you are.
So I've just turned 50. And
okay.
So this year, no midlife crisis just yet, so that's okay. And so I'm going to do a trip over to Nepal in a couple of months to do a little bit of hiking. And so, look, I'll keep working. I love working. I love working who I work for. And so retirement is not on the agenda as such. It'd make things easier for my wife, so have a choice there. But ultimately, I've still got 10, 15, maybe 20 years of working what I currently do because I currently enjoy it. And my company's quite a good company to work for.
Yeah. What do you do for a living?
So I'm the head of property and procurement for a large international company. And so not residential, but commercial. So more of the procurement side of things. And so over the years, and then we've taken on the property and insurance portfolios as well.
So you buy stuff for the company that you work for? Is that pretty much largely it?
Yes. Yeah, we'll manage the spend, the contracts, the purchasing, make sure we're procuring in the right way, and also look after leasing and things like that with the business.
And what's your background? Do you come from a legal background to do that work, or what sort of discipline, accounting?
Well, originally it was a military background. So I started my working career in the military, and then, like I said, I got into law firms after that, and then went and did an MBA, while I was working, and then continued through that process. So I was quite lucky that I used to work for a large company. They paid for my schooling while I was working, and then continued that process. And I've worked in the finance teams for quite a while. And so we support good managers and a good business to work for.
Yeah. What arm of the military were you in?
I was in artillery, army.
Artillery guy. Yeah.
Yeah, drop shot. Not my sniper.
How long did you serve for?
Just 4 years. I was in when I was fairly quiet, but I didn't know what I wanted to do in life when I was younger. So ran away, joined the army for a while, sorted my head out and come back and then got back into it. And so,
it's probably great grounding for a lot of kids to do that, it's sort of the interim step, or you can make a career out of it. But no doubt you learn a lot of skills that you probably still use today.
Oh, very much so. I had to sort of retrain the offset, to come back into normal working life. So the military is a little bit more rigid and structured, but it's helpful to get employment as such moving forward after that. Everyone here is from a military background. A little bit different today. A lot of the military is coming back from overseas, and there's a few more issues, I think. But when I was in, it's certainly set a good foundation for me to have a good working career.
Yeah, I say that a lot in a lot of the military and ex-military people I know. It's this, I guess, this doctrine of learning, right? You get taught how to learn, essentially, and the benefit of coaching, but formal learning and training. And you see people that embrace that, and throughout their life, they're always looking for new ways to learn, and they quite enjoy the learning experience. And no doubt, property investment is part of that. So you said you sort of just hit the big 5-0. So you've been investing since the last decade or so. What was the catalyst to get you into property investing?
It was actually when I met my wife. We sort of moved in before we got married, and I'd always been interested in property, but never knew how to start. And when we were moving in, I found a book that she had. I think it was Land Spices, how to make 130 properties in 3 years or something like that. But sort of started reading that, and then sort of wasn't sure if that was realistic or not, but looking at the fundamentals of that. And so that's sort of just started reading that, and then said to my wife, we should look at buying an investment property. And and then I started that way. So, and then before you went online, I was subscribed to Smart Property Investment magazine, and so I used to get them delivered at home.
Old school.
And so, I still got them all at home.
Do you really?
Yeah, I still got most of them. Yeah, and so
wow. You must be one of the few people with a full suite.
Well, I went back and read it, and I thought, wish I had followed your property back then. So I would have probably done a lot better. So it's interesting to go back and review how that's. Sort of, where it was and, where it is today and how much it's changed. So, hindsight's a wonderful thing. But ultimately, it's just do our best and hopefully it'll pay off one day. And so,
well, it sounds like you're doing the right thing. And every single property investor I know, when you ask them, what's the biggest mistake you've made in property, they'll tell you two things. One is, I wish I started earlier. And the other thing is that I wish I did more when I could have. If I had my time again, I would have bought a lot more when I could have. I was just maybe, a little bit risk averse and all that sort of stuff. And I'd probably fall into both those buckets myself. Hence the reason why we cover the Smart Property Investment portfolio on this show. So we can sort of, and if you haven't been tuning into it over many years, I'm going to be doing updates shortly on it because I'm going through a whole big round of refinancing. I think using the same mortgage broker as you, Ryan, Finny Mortgages, finny.com.au. So I'll be sharing that moving forward. So let's chat about your portfolio, Ryan. We'll just go to a quick break. Stay with us. Back in a moment. Welcome back. It's Phil Tarrant, host of the Smart Property Investment Show with property investor Ryan O'Neill. Ryan, the notes I have here is 5 investment properties. Then you've got another 2 properties in your self-managed super fund, and you currently have your principal place of residence. Did you buy your principal place of residence first before you started investing in property, or did you buy an investment property first?
No, well, my wife had an investment property first before, and stupidly we sold that, sort of when we bought our first place. But no, we bought a principal place residence first in the hills. I renovated that and then sort of bought the next place into upscaled a little bit, I guess. And then sat on that for about 3 or 4 years, and then decided that I think it's a good time, or we think it's a good time to get into property investment. So
you bought your first principal place of residence and you traded up to another principal place of residence. So you sold that, bought principal place of residence, and then you started investing.
That's correct, yes.
Yeah. What sort of uplift did you get from your first principal place of residence to the second one?
We bought for about $426, and we did a small renovation on it and sold for about $540 or something like that, I think.
Yeah.
So, and then we bought again for $590, and so sort of in a better area where we live, trying to get into a nice area. And then we sat there for about, I think, 3 or 4 years before we then decided to take a little bit of equity out of that when it moved a little bit. So it wasn't moving as much as it did then.
Yeah. Whereabouts in the Hills area are you?
So we're in Borkham Hills, sort of just near the new train station, near Norwest train station.
Yeah, Borkham Hills is a good spot. You must have been happy when that train station come in?
Well, we're only about sort of 500-600 metres away from it. So that's sort of far enough away not to be near the apartments, I guess, but close enough to walk. And yeah, we've seen a large, big capital growth in properties out there. We bought at the right time. So it's
I reckon you've done very well in Borkham Hills. What did you pay for it? 520, 530?
No, 590 for that one.
590. And today, valuation on that?
Conservatively, 1.9, probably 2. And so,
So you've done well.
I like to be conservative, yeah. And so it's interesting.
So you reckon you've pretty much nearly 4 times the investment over what period of time? Like 13 years?
Yeah, that was 2011, that one.
2011, yeah, wow. That's a good investment. That whole area around like Baulkham Hills, Castle Hill, Kings Langley, and even if you go a little bit further out west from there, it's done exceptionally well. Whether or not it'll continue to do what it's been doing, is a huge amount of infrastructure development out that way as well. Have they finished the Baulkham Hills sort of town centre area there, right opposite the Bull and Bush Hotel? Because there's a huge amount of development going on through there.
Yeah, they're just knocking down some of the existing buildings now. So you've had previously Gildan building apartments on one corner, and then they're talking about the Bull and Bush now, what to do with it as well. And then across the road, they're starting to knock down that building, and I think there's more commercial and residential going in there on the corner. So it's crazy. It's very busy around there now.
Mate, it'd be criminal to knock down the Bull and Bush. That was like when I was growing up, that was a rural property, right? A rural pub.
Yeah, exactly. So
were you brought up out that way?
No, I'm originally from Melbourne. So when I came to Sydney, I lived at Bondi for a few years, had an apartment there, and then met my now wife, and she dragged me out the hills.
Yeah,
me right away from Bondi.
Place to live the hills. And you've got where's work for you? Is it in town or you're out that way?
For me, it's in town in Port Botany. And so I do a long drive, and so that's why I listen to a few podcasts on the way in and one on the way out and everything else, because it can be an hour and a half, 2 hours sometimes one way.
Wow. A smart way to use your time effectively, though, is working on your education. Maybe that's your military background, mate, to keep learning and using your time. I know a lot of people would just waste time in cars, listening to the radio and listening to music. Such a perfect time, or a train commute or whatever it is. Get yourself educated. There's some pretty good podcasts around at the moment, Smart Property Investment being one of them. But
exactly.
Investment property, so where was your first investment property?
Our first one was in Adelaide. And so back in 2013. And so we bought in Hackham in Adelaide.
Hackham.
And so
for 2013. And was it a house did you buy?
Yeah, everything's a house. We've always bought houses.
Okay. So what'd you pay for it?
We paid $250 for that.
Okay. And today?
It's $440.
Yeah, I was going to say you've done well there. Okay. 2013. What sort of yield, what sort of rent are you getting on that?
We're getting 310. About to go up to about 330, I think.
Yeah. You expect to see rents rising right across Australia moving forward. Been recording about it. Go and tune into it on smartpropertyinvestment.com.au. What was the next property there, Ryan?
Next one was in Crestmead. It was another one for $250.
Crestmead. Where is Crestmead again?
That's in Queensland.
Oh, yeah. $250 today?
It's probably about $440, I think.
Yeah. It should continue to sort of move. And what sort of rent are you getting?
We're getting, actually, I just put that one up. We were getting $335. We're now getting $385.
Well, that's a big jump.
Yeah, but look, they seem to be all around there. So the current tenant accepted it. And I think we're a little bit undervalued there for a while.
Yeah. Yeah. Okay. What was it? When was that? 2013?
That was 2014, that one.
2014. What was next?
Then we bought, I think it was Raymond Terrace.
Yep, Raymond Terrace. Okay. That's north of Newcastle, for those of you that don't. It's probably an hour north of Newcastle, Raymond Terrace, thereabouts on the Pacific Highway. That new road there's helped out quite a lot up through there. So when did you buy Raymond Terrace?
It was 2015, I think.
2015. What'd you pay?
$200.
Okay. Wow. Today?
$460, probably.
Just madness to think that you're paying back in 2015 $200,000 for a house.
Yeah, it's crazy.
Just now you just go, whoa. But back then it's still a lot of money. But okay, what was the next? What was the rent on that?
That one's at $380. Sorry, $310. That one I think is at the moment.
Okay. What was the next property?
Lavington down near Albury.
Yep. When was that? 2016.
Yeah, around about then.
Yeah. What was the purchase price?
$200 again.
Yep. Today?
That's conservatively probably about $390, $400
okay.
probably.
And these are your outside of your superannuation?
Yeah.
Yeah. And what was it? What's the last one there in your portfolio?
The other one is Deception Bay.
Okay. Queensland. It's a suburb of Brisbane to the north. What'd you pay for that?
We paid $320. Sorry, $313 for that one.
And today?
It's probably over $500.
So you built yourself a nice little portfolio, or a good portfolio with plenty of equity in it. And Have you refinanced those properties on the way through in order to keep buying?
Yeah, there has. I'd kept the same lender for a while, and then wanted to take some equities, reshuffle around, get some more equity out to purchase again during that process. And so then we had trouble probably 2018, 2019, when it was really hard to try to get. We wanted to keep buying and buying, but then we just couldn't get finance. Ultimately, servicing became an issue. So we just sat down and just let it go through. Then ultimately now we've refinanced them all just recently with Finai again. And so
yeah, and sometimes you just need to wait and tap out, and either you change your serviceability profile, make more money, or your yields might change on your rents to give you more income. And your self-managed super fund properties, where are they? Right?
Yes, another one's in Crestmead, and so again similar to the other property.
Yep.
And then the other one's in Goodna, and so
whereabouts?
Goodna in Queensland.
Goodna. Where in Queensland is Goodna?
That's towards Ipswich.
Oh, okay. And they're just sitting in your super fund, just ticking away, topping up your contributions. Will you buy any more in your super, or you'll just leave it as is?
Well, I'm looking at the moment. So I'm looking at Perth at the moment. So talking to some people over there, and we're thinking about trying to buy into 15Ks around Perth. So we're just doing some numbers now, and see how we go. So ultimately just trying to build up a little bit of equity, and hopefully maybe this year I think might be able to get another one.
Yeah, and in terms of sort of longer term play for your investment portfolio, so let's just park the SMSF stuff. So for the actual outside of SMSF, your investment property is 5. So the plan is to keep buying while you can, or if you can.
I think so. Yeah. So it's not afraid to try to do that. So we did a projection, I think in 2016 or something like that, to see where we're sitting, and the value of those properties currently are past where we predicted they'd be in 2028. So ultimately it was get to 2032, and that would be our retirement budget as such. So we're tracking over a 2028 period, which is quite good to see. So we'll just keep going, try to get a bit more equity, and then ultimately, now we bought some of these properties. I think we're quite lucky where we bought, and they've moved now. But our next strategy would be to engage with professionals to try to find the right property with good capital growth, during that period now.
Yeah, well, you've got a really good foundation there with plenty of equity. You're not even touching your principal place of residence. And what sort of philosophy have you got towards that? Is your principal place of equity, untouchable? You don't plan to be drawing out any equity from it. Are you looking to pay down your principal place of residence? What's the game plan there?
So everything at the moment, we're paying everything down. And so all of them are, our principal place of residence is interest only, but everything else is paying everything down a little bit more while the interest rates are so low. And we decided it's an ample time to just pay as much as we can down off, and build a bit more equity that way while they grow, pay down the loans, and ultimately maybe take some more out later on. So we did take a little bit out of our line of credit out of the Baulkham Hills previously to start our purchasing many years ago. But
And do you plan to get their principal place of residence completely paid off at some point? Because so you said you paid $590 for it. What's the debt on it now? No doubt you've refinanced it a couple of times.
So the total debt, including line of credit, is about $700.
Okay.
So
you've got a lot of equity in your principal place of residence. Yeah.
Yeah, and we haven't touched anything out of the other properties either to date. So it was hard to get financing previously. So now it's sort of the capital growth has grown a little bit. So now we're sort of looking, okay, what can we do now? Career-wise, so that's progressed as well. So that's given us a little bit more ability to do things at the same time.
And these things all sort of happen in isolation, but when you combine them all, increasing career and therefore earning potential, capital growth, you've got rents going up. When you start sort of bundling them all together, it starts to get this sort of network effect of complete upside, and that typically makes banks a little bit friendlier to you than otherwise. Obviously, servicing with the banks has sort of changed recently, where they've upped the buffer between what they assess you at and what you actually pay, and just that will continue moving forward. And as we go into this sort of cycle of increasing interest rates, it will get tighter for lenders moving forward. What including your principal place of residence, what's your sort of total debt levels, would you say, Ryan?
Total debt's about 2 million.
Okay. And your total sort of valuation of all those assets?
It's about 5.4.
Okay. Wow. That's a pretty good LVR at what, sort of 40 odd %, right?
Yeah, I think I worked out about 40.36 or something like that it was.
Yeah. Is it 40.36? That's not a bad sort of quick...
I'll try to track it.
Sorry, I rounded it down, so I got it right. There you go. But, well, mate, that's a really smart portfolio you've built out there. You've got plenty of equity there. And if you think about it, if you sold down everything, kept your principal place of residence, it's a nice chunk of change that you could chuck against your principal place of residence anyway, or just have it as cash flow. So this sort of idea of having choice in retirement, or whether or not that might just mean for your wife, that would resonate. But you want to keep going with it. I understand you're doing some financing at the moment with Finny Mortgages. Let's have a chat about that because I'm going through the same process. So we'll just go another break. Back in a moment. Welcome back, everyone. It's Phil Tarrant from the Smart Property Investment Show with property investor Ryan O'Neill going through financing. So the idea of financing, Ryan, at the moment with finny.com.au, is it to get better rates, sharper rates, to refinance to interest-only loans, or to free up some equity to keep buying? What's the game plan?
It's to free up some more equity to keep buying in the future. And so interest rates is not an issue. I don't think it's, we calculated a higher rate anyway on where we currently are, but it was to realign all the mortgages, and then allow us then to start looking at what we can do in the future. And so it's the capital growth.
Are you refinance at principal interest or interest only?
Principal and interest, yeah.
Okay.
And so I want to keep paying
fixed or variable?
Variable.
Yeah. And what's your variable strategy? Just so you're not sort of pegged down with any one interest rate. You've got more flexibility. I see fixed rates have gone up rapidly anyway recently, so you're going to get sharper variable rates. Are you just looking for that flexibility?
Pure flexibility, it's to allow us to do more. Basically, it's the interest rates. Yes, we looked at a couple. We did have a high interest rate on our self-managed super fund, so we're currently reviewing that. Where I was plugged in with a previous broker, and that was quite high. So I've dealt with Finno, and they've brought that down by a couple points actually. So that'll save us a little bit of money to then allow us to do a bit more in that future. So yeah.
That's a key tip. A lot of people that took out self-managed super fund residential lending sort of 5-6 years ago, rates were a lot higher. They're actually coming a lot sharper now, resi rates inside the SMSF. So if you're paying sort of 5-6%, definitely speak to your mortgage broker because there's a lot sharper rates out there. And if you get that saving in your super fund, that means that you're just building up the asset base in there and allowing you potentially to go again or use that cash for some other purposes. But how are you finding the financing process with five loans plus your self-managed super fund? You sort of probably starts getting the realm of where I am, where it's not the easiest process, not because it's easy to do, it's the amount of documentation you need. Going to be pretty administratively good to actually get all the stuff you need together.
Very much so. This started a few years ago where back in 2013, 14, 15, it was sort of easy to get loans and the paperwork was quite easy. There was a massive change, at the end of that decade where all of a sudden it was jumping through hoops. Everything had to be documented and checked. And so now we manage it. It's like a second business. It really is to manage the properties. There's a lot of work to be done. There's a lot of after hours work, same as you, probably good spreadsheets and, good organizational skills and spending a bit of time on it. And, we just keep records of everything now. And once we know what the banks sort of expect now. So it's still a process, but going through with Finno, it's been a lot easier this time. I have to say that's for sure. They have helped quite a lot. But yeah, I think it's just a new world. It's just the way it is. Everything's got to get checked, and we try to keep in check our discretionary spend, I guess, our credit cards, and we don't sort of so we know that's where the banks will look straight away. And so.
Yeah, I guess, your mortgage broker is only as good as how well you equip them to do their work well. What's your sort of number one tip to get the most out of your mortgage broker?
I guess be organised, so, have everything ready. Just be organised. I think just you need to get ready before you start approaching this. They ask a lot of questions, there's, right through the whole process, and it does take a while to get through.
Yeah. Working with a mortgage broker, and I've used mortgage broker for all my loans. I'm currently myself using finny.com.au, that's finni.com.au. try and give all your information in one go rather than drip feeding it through. It's much easier. So that's to Ryan's point about being organised, keep everything connected, engaged. It makes the process a lot simpler and easier. And you put the broker to work trying to find you the most appropriate loan for your needs. Ryan, when do you think the next purchase will be? Have you got a time? Have you got a location?
Like I said, we're hoping this year. And so we're talking to a buyer's agent in Perth at the moment, and looking over there. So hopefully next couple of months.
So is the team over at Finning going to sort you out the pre-approval for the next purchase as part of this?
Yes.
Yeah. Okay.
Yeah, very much
Again,
so.
that's a good time to do it. If you're going to do any financing, you might think, well, that's way too much, but it's best if you're going to go through the time, energy, and effort to get all your information together, you're better off doing it all in one go, whether it's a refinance, whether it's a redraw. And a lot of people I know now are taking equity out of their portfolio, seeing they've had this growth. But while you're at it, you might as well get yourself a pre-approval. If the bank's ready to prepare it, the best time to buy is when you can afford to buy. Ryan, when you're ready to go, mate, when you buy something, you have to come and tell us all about it.
Lovely. Beautiful. And so
nice one. I look forward to that. That's Ryan O'Neill, a property investor. And if you want to come and have a chat with us, I really enjoy chatting with investors. That's the basic premise of this podcast. Get in touch with the team editor at smartpropertyinvestment.com.au. And whether you've got one property or you like Ryan with 7 properties, 5 of them outside of super, 1 of them in super, 2 of them in super and his principal place of residence, irrespective of where you are on your journey, it'd be great for you to come and share your story with us. Remember, social media is Smart Property HQ. Favour for me, please, and no doubt Ryan will do this as soon as we've finished with this podcast. Please keep those reviews coming wherever you're listening to this. Most of you on iTunes. The team get a real kick out of it, particularly those behind the scenes here that do all the heavy lifting. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.